All right, hi everyone. My name is Ray Dai. I'm a realtor with the Live Local team here in Phoenix. And I'm here with Bert Musser. Bert is also a realtor on the team, and we're both with Real Broker. Bert, do you want to give a quick intro to yourself?
I'm a new licensed agent, but I'm not new to real estate. I've been in the broker world. I got my start in Las Vegas in the early 2000s, around 2004. Quite a bit of information that Ray and I would just like to share with everybody.
Yeah, so Bert, before you became a realtor, your past career was a loan officer, correct?
Correct. Correct. I had not only just a loan officer, but casino gaming also, which I like because it's numbers, so we like dealing with
Cool.
numbers and things like that.
So in today's video, Bert, I'm going to ask you to share a few real life stories where you helped secure a deal through special ways of financing, and some of these options are what people may not realize that are available. So, Bert, why don't you kind of give us a little bit background and jump in?
Sure. A lot of these scenarios that we're solving problems with, it's being solved in what they call the non-QM world. So QM is qualified mortgage, and that's your basic Fannie Mae, Freddie Mac, FHA, VA loan. Non-QM, these are loans that use alternate types of documents to prove income or the ability to repay your mortgage. We're still using documents to show that you can pay your mortgage back. It's just not specific ones like W-2s and pay stubs. And so, how I'd like to start with it is most of my background is in the investor world, investment loans. And so, I'd like to start with one that I'm really proud of myself, where another loan officer brought it to me so we could collaborate together.
Hmm.
That's one thing I am proud of that I do like is that even myself, if there's something that I feel that I can't get approved, I will bring it to another loan officer that has experience and just a fresh set of eyes.
Right.
So this was a purchase for an investor of 400 units, a 400 unit apartment complex in Alabama.
Wow.
And so what it was there's 200 units on one side of the street and there's 200 units on the other side, and out of those 200 units on one side, they were completely empty because they needed to be renovated. Now the issue was they were originally just going to do one purchase loan of $4 million, but the investor would have to bring 40% to the table as a down payment, and that for 4 million times 40%, that's $1.6 million as a down payment. So the other issue we were having is being able to have any type of income to qualify for the purchase of this apartment complex. So with
Hmm.
half of the units being empty, there's no cash flow. So it made it really
Right.
hard. So Ray, what we did was we asked the seller to, can we make it into two different apartment complexes? And so it took the seller a little bit of time to do that with his attorney. So what we were able to do is the vacant ones he sold to my investor for 2 million. We used a pretty much like a construction loan, ground up construction. It's like a fix and flip requirements, usually about 10% down. And so 10% of 2 million, that's 200,000. And
Right.
then what we were able to do is the other units, the 200 units across the street that were being rented, now that apartment complex cash flows. The income from the rent is higher than the new mortgage. So we don't have to ask the investor for tax returns, anything like that, because we're not using his personal income. And with the down payment requirement on this was 20%. So we're looking at 2 million, 20%, 400,000. So total, he's coming out with $600,000 in down payment instead of 1.6. So these are options we're able to provide, which means that investor saved $1 million that he didn't have to come up for his down payment. and we were still able to, get him the doors that he wanted, because he had a specific goal to get so many properties.
Okay, pretty amazing. And what are the specific loan types involved in this transaction?
Okay, so the vacant units, like I said, it's almost like a fix and flip loan. And so how a fix and flip loan works is it's usually 10% of the purchase price is the down payment, as long as the ARV, and that stands for after repaired or after renovation value. So after the property has been renovated, what the new value is, as long as that amount is not over 75%. If it's not going over 75%, then if we meet those parameters, then it's just 10% down. So if you find a property that $100,000 and you can repair it, and then the value after the repair is going to be 75%, then you're only going to need $10,000 down. I mean, imagine that. You're getting your first investment property or a fix and flip property 10% down.
Wow. Okay. And because these are investor loans, Bert, you personally can work across the United States, right? You're not limited to the states you're licensed for primary residence.
Correct. So anything that deals with someone buying their primary residence or their secondary home, I would have to be licensed in. But since these products are pretty much considered commercial or business purpose, as a loan officer, I don't have to be licensed in those states.
I feel like the truly creative thinking here was you guys worked with the seller, right, and their attorney to legally divide up the units so you can do two different types of loans and financing to help the deal move forward.
Correct. As long as we can get everybody to get on board and cooperate, there's usually a way that we can structure it. Usually in the mortgage world, we need three different things that we're looking for an approval or to get somebody a loan. And we usually like to use the acronym CIA: credit, income, and assets. Now, when it comes to commercial loans and things like that, if you can give me 2 out of 3 of those, and they're strong, you know what I mean, like you have a good amount of down payment, or you have a good amount of great credit, and you have assets, then we can use those 2 factors to overlook that third one. So there's a lot of options and a lot of wiggle room when it comes to these programs.
Fantastic. Well, thanks for sharing. Do you have some other story, maybe a different flavor?
Yeah, actually one that really comes to mind, that especially with the holiday seasons and everything like that. And this isn't it's not an investment loan, but I have a family that's in northern Arizona that is going to be using a USDA loan for their dream log cabin. And the big thing is with us being here in Arizona and speaking to a lot of realtors and a lot of other people, we really do have a lot of areas here in Arizona that do qualify for USDA loans. And that doesn't mean you got to buy a farm. You could buy a house sitting on like a quarter of an acre on a USDA loan, as long as I enter that address into my portal and it says it's eligible.
Okay, so who says whether a property is eligible or not?
Well, it's actually from USDA, and they have a way that the portal calculates the population density and things like that. It's just a way for people to get into a home with 0 down payment. There's no mortgage insurance. And here's an actual benefit that's completely different on USDA versus other loans, is that right now we're in a buyer's market. Would you agree on that, Ray?
Yeah.
So,
yeah.
Ray finds you a home and we're using a USDA loan. It's in a perfect time where Ray is going to be able to negotiate concessions. And the concessions are just money from the seller to help you pay third-party costs for your closing costs, your title insurance, lender fees, things like that. But on most loan programs on the QM side, if there's any money left over or that's from these concessions, it will usually go back to the seller. Now, the benefit with the USDA, those extra funds will go to the buyer and it will go towards the principal. So that's an extra value with USDA, is that if there's any concessions or money left over from concessions, then it
Right.
can be applied towards the buyer's principal.
That's amazing. So the buyers can save additional money, right, from the loan program. They don't have to contribute from their own down payment.
Correct. So that really, saves them money out of pocket. You know what I mean?
Yeah, and you don't have to buy a farm. Did I hear that?
No, yeah, you don't have to buy a farm. If it's a plot of land and somebody put a nice manufactured home on there, you could use a USDA loan to buy that house, that manufactured home, sitting on that lot of land. As long as the mobile home's not sitting on lease property or anything, it's sitting on the property that they own.
So it's all based on the areas that are designated by the U.S. Department of Agriculture.
Correct.
Awesome. And Bert, which states are you licensed to originate USDA loans?
USDA is going to be the same thing. It's going to be somewhere that I'm currently licensed, which is Arizona, New Mexico, and Texas.
Awesome. Cool. All right. Well, do you have a third story?
Oh, you know I do, Ray. You know I do, Ray. Have you been financing properties and rental properties since 2004? You know there's a lot of stories. Another great one that I really like is, I'm a new realtor, and so the reason I became one, it's kind of by accident. I went to real estate school just so I could find out what realtors were being taught as far as finance, so I could actually approach and talk to realtors, better.
Mm-hmm.
But I ended up just going and taking the exam and becoming a realtor. Another misconception is I have to be self-employed 2 years.
Okay.
Normally,
Yeah, that's what we hear.
Yeah, that's what we hear. And here's the thing. If I was still working at a retail lender, and the one I worked for here in Arizona was People's Mortgage, and it's the same, Rocket Mortgage, Loan Depot, I would not be able to offer
2
that.
years.
Yeah, it would have to be 2 years. But here again, why brokers are better, having 200 banks and thousands of programs. There's a program out there, you can be 1 year self-employed, as long as it's in the same field as when you were a W-2 employee. And the the story I would like to tell on this one is, I have a young family. They are looking to buy in a new development, and so traditionally, in a new development, you would have to use their preferred lender. Correct, Ray?
Correct.
All right. And then, so what happened was, most of their lenders, they're retail. They're going to need 2 years self-employed. And so their preferred lender denied this family. And then they went to their builder's secondary lender, got denied. And then came to me, and he was technically only 10 months self-employed, but the home wasn't going to be finished for another 6 months. So we were able to get an exception and get a qualification to where this family got into a home, and the husband was self-employed less than 2 years. And how we connected the previous employment to his new self-employed company is that he was a firefighter that drove fire engines and that required a commercial driver's license. And so the company he opened is a trucking company, which requires a CDL. So from being a W-2 professional driver, now he's self-employed professional driver, both requiring a CDL. We were able to get an acceptance and get this family into a home without being 2 years self-employed.
Great. So that's the same driver's license from the same guy. I guess the big bank lenders just would not accept that as a self-employment, but you're able to find somebody who would. and they're able to move in.
Correct, correct. Just being able to provide solutions, and it's just a great feeling. And I know you know that feeling too when you're able to get a family into a home.
Yeah, that's awesome. Well, I'm sure you have a lot more stories to share. People let us know in the comments if you want to hear more from Bert. And I think, well, that's it for today. Three great stories how Bert used financing to help, families and people secure their real estate dreams.
That's right. That's right. There's a lot of options out there. Don't be afraid to make
All
a
right,
move.
cool. Well, thanks, Bert, for your
Great.
time
Thank
and
you.
sharing. Yeah,
Thank you for having
bye.
me.